There are some important biases that we have as human beings, and we don't lose those when we get in front of a Bloomberg. For 40 years, interest rates went in one direction. They just went down. People came to think that's the normal state of affairs.
Hello, everyone, and welcome to a new episode of The Blunt Dollar. Today's guest is Dean Smith, Chief Strategist at FolioBeyond and one of the sharpest minds in fixed income. He's not afraid to call out where the Fed gets it wrong or how complacency has crept into some corners of the market.
We fall in love with our investment thesis. Recovering from losses is really tough. If you have a 50% drawdown, to get back to even, you need to have a 100% return. When you have a strongly directional market, it's pretty easy to look like a genius. The hard part is when that trend breaks. Do you catch it?
This is The Blunt Dollar with Ignacio Ramirez. Quick disclaimer, the views and opinions expressed in this podcast are those of the speakers and do not constitute financial investment or legal advice. This content is for informational and educational purposes only and should not be relied upon as a substitute for professional advice. Always do your own research and consult a qualified advisor before making any financial decisions. All investments involve risk, including the potential loss of capital. And now, let's get started with the episode. Hello, everyone, and welcome to a new episode of The Blunt Dollar. Today's guest is Dean Smith, Chief Strategist at FolioBeyond and a 25-year veteran of the structured products world. Dean has done it all: investment banking, trading, managing hedge fund portfolios, and helping write a book literally on collateralized mortgage obligations. We might be talking about that, of course. He's held senior roles at firms like DLG and Nomura, earned degrees from Columbia and UC San Diego, and built a reputation as one of the sharpest minds in fixed income, particularly when it comes to mortgage-backed securities, risk modeling, and AI-driven strategies. But what sets Dean apart, in my opinion, isn't just his resume. It's how provocatively he thinks. He's not afraid to call out where the Fed gets it wrong, when markets misprice things, or how complacency has crept into some corners of the market. In this episode, we'll get into the dangers of overconfidence, the art of staying curious in a cynical industry, and what markets teach you if you're paying attention. Dean, it's an absolute pleasure to have you on the show. Welcome to The Blunt Dollar.
I'm happy to be here.
So I always like to start my episodes with the same question, but can you tell listeners what is it that you're doing today exactly?
Well, my day job, if you will, is I manage 2 exchange-traded funds for my company, FolioBeyond. One is an interest rate strategy that provides diversification and helps people manage interest rate risk in their fixed income portfolios. The second one is a AI-driven strategy that allocates across the entire fixed income marketplace using a dynamic algorithm that looks at a bunch of different factors and helps people get exposure to different sectors when the time is right.
And as part of those day-to-day operations, what does your role in the company exactly consist of?
Well, as the chief strategist, I'm tasked with trying to figure out what is the tone of the market, where are things going, where are we in terms of risk tolerance, and what's happening with economic policies. Those are things that are really, really important to developing a sound investment strategy. I'm also responsible for the day-to-day management of these funds, but I really like to characterize what I do as looking at the big picture for the most part. I like to say that if you get the macro picture right, the rest of it kind of falls into place. And I definitely think that's true. I think that you need to be focused on security selection and sector allocation and diversification, all the kinds of things we're going to talk about. But if you get the macro picture wrong, it's going to be tough to overcome that.
So plenty of things to unpack there. But first question that comes to mind is, did you ever know you were going to become a chief strategist in a finance company? Or is that something that happened a little bit coincidentally over the years?
Yeah, it's a little bit of a story there. I won't get into all the details, but when I was a young man, just getting
You
into
still are, Dean. You still are.
getting out of high school and starting to think about college, I was a musician. I was a singer and a guitar player and played in different bands in my hometown of Baltimore, Maryland, where I grew up, and moved to California at one point to try to become a rock and roll star. That didn't work out. For better or for worse. Maybe for listeners, it's for the better. But I went back to college, got interested in economics, and from there made it back to the East Coast to New York for graduate school and started working on Wall Street. And one thing led to another. But I certainly, when I was a young person, we didn't have finance in our family or anything like that. It was I'm certainly the first in my family to take this direction.
That's pretty cool. I mean, from literally rock star to hardcore
Very,
finance. I
very,
mean,
very small
there
rock,
is,
very local.
but they are literally on opposite sides of, let's say, a spectrum. I don't know which spectrum is it. Maybe the creative spectrum. Can you?
You know,
Can you?
I think you're right there. I think there is something to that. There is obviously, to be a musician, as a working musician, there's a creative element to that. There
Mhm.
is, you need to know what your audience wants. And I think there's some similarities there in managing money and managing risk. You have to be creative. You need to not just simply check the box, and you need to be in touch with what your audience, your investors are looking for. So maybe it's not 100% overlap, but there's definitely some similarities.
Yeah, I'm curious about that actually. What are the Since you went so deep into both fields, music and finance, what are the skills from the music world that you feel help you the most to become so successful when looking at markets?
Wow, that's a really interesting and deep question. As I'm thinking about it here, one thing that immediately comes to mind is that in both cases, things are not necessarily what they seem on a first impression, or as you're looking at things for the first time from the surface. Um, in any good musical composition, there are layers to that, and there are elements and contrapoint and all sorts of harmonies, things that you need to really spend some time thinking about to really understand what's happening. And I think a lot of that happens when you're looking at markets and you're trying to invest intelligently. Sort of things are in many times much more complicated than they appear on a first impression. And what you feel about a particular investment or a strategy right out of the gate, the more you explore it, you find more and more nuance and interesting things, and your first impressions are often not the correct ones. So I think there's some similarities there as well.
Um, whenever so I'm a fixed income advisor. A lot of times I'm making presentation to uh, young people, people that are just getting started into markets. And I like to use analogies comparing asset classes to different style of music. Fixed income, I like to compare it with smooth jazz because of its predictability. And I like to compare stocks with rock. Um, um, and it's funny because you were into rock, you said, which I would have connected with equities, high beta stuff, very volatile, and so on. And yet, you made a big part of your career in fixed income, which is known to be maybe a little bit more of a less volatile, more calm kind of asset class. And did you ever know that you were gonna work in fixed income and that you were gonna get into the more complex part of that market, or again, did that happen a little bit randomly?
Actually, you hit on something that's quite interesting. Uh, first of all, I love jazz. I'm a huge fan of jazz music. And for a number of years here in my current hometown of Charleston, South Carolina, for several years, I served on the board of a not-for-profit organization called Charleston Jazz. And we sponsored a big band jazz orchestra and a jazz academy for students and all sorts of jazz related events and education. So I think your analogy is actually quite interesting. I think you're onto something there. But in terms of how I got into fixed income, I didn't really know until I went back to college that I was actually pretty good at math. In high school and when I was younger, I didn't really think much of it. High school wasn't particularly challenging, but when I got back to college and I took a class in economics, the professor pulled me aside and he said, you're pretty good at this. Have you thought about following this as any kind of a career path? And that really piqued my interest. And so I got interested in economics first, in particular because I really enjoyed the mathematical aspects of it. And when I got back to New York for grad school, obviously you're in the heart of Wall Street there. And that training in economics naturally led me to finance. And if you want to talk about the most mathematical areas of finance, it's definitely fixed income. And within fixed income, it's definitely structured finance, mortgage-backed securities, asset-backed securities, those kinds of things are highly quantitative. You can't really do those kinds of products without having a strong math background. So I just sort of naturally gravitated to that area of finance.
So I have a lot of questions about ABSs and MBSs, but before that, I want to come back to something you said. Part of your role as a strategist, chief strategist at FolioBeyond is, as per your own words, getting the macro tone and trying to see where the markets are going. How do you do that? I mean, what do you read in the morning? How do you get that? That color about the market? What are your sources of information? Is it something that it's innate, or can you develop it over time? Give us a little bit of insights on how one can become a good chief strategist and get a feel of the market like you do.
That's a great question. And I certainly would never compare myself to George Soros, who's obviously a great investor, and Scott Bessent was the current Treasury Secretary, worked for George Soros for a number of years. But Soros did say something once that I find very compelling. And he said, I don't make predictions, I just observe. Okay. So that's really important. I try not to make really detailed long-term predictions about specifically what's going to happen to the S&P, specifically where our interest, where's the 10-year going to be 3 months from now, those sorts of things. What I really try to do is step back and get a sense of the big picture of where we are in the economic cycle. What is happening with economic policies? What is happening with trade flows? What is happening at the Federal Reserve, sort of listening to what they're saying and watching what they're doing. So there's no single source of information that I rely upon. I read a lot. I consume a lot of content from both traditional, Wall Street Journal, Financial Times, things like that. I read a lot of academic research, which in many cases is very granular and not particularly helpful in forming a macro view, but it gives you a sense of the kinds of things that really smart people are thinking about, okay, problems they're trying to solve. And so I think you have to be an omnivore, right? You have to really consume a lot of different perspectives. I take a lot of care to look at and consider perspectives that I don't necessarily agree with. So, I'm definitely a capitalist. I believe in the free market system, but I also pay a lot of attention to people who are on other sides of some of these issues. They've got a lot to contribute. And I think that if you allow yourself to get, sort of go down one particular rabbit hole and not sort of consider alternative viewpoints, it's very tough to get the big picture. And I think that is something that, social media to some extent kind of amplifies the narrow perspective. It tends to feed us what we've already seen and already said we like. So you have to make an effort to seek out other points of views. And I definitely make that part of my routine.
And consuming all that content, I guess you've seen lots of good calls and lots of bad calls from other investors. Why do you think so many brilliant investors, other strategists, other CIOs, other portfolio managers still make bad calls in markets?
Well, there are some real important biases that we have as human beings, and we don't lose those when we get in front of a Bloomberg. The economist Daniel Kahneman pointed out a bunch of these in his book, Thinking Fast and Thinking Slow. And so one of the biases that we have, it's just innate to our brains, the way we think, is something called recency bias. Okay. We tend to believe that the things that have happened most recently are sort of the normal state of affairs. Okay. And we see this today in the interest rate market. Okay. In the interest rates on treasury bonds and monetary policy and so forth. So for 40 years, starting around 1980, interest rates went in one direction. They just went down. And we were in a 40-year bull market for bonds that seemed like it was going to last forever. And we got to the point where interest rates were pretty close to zero. Okay. And people came to think, because that's what they'd seen, that's the most recent environment that they've lived in, people and still tend to think that's the normal state of affairs. Okay. If you step back, though, and look at a longer history, you'll see that the current level of interest rates, 4 and change on the 10-year and, 4.75 to 5 on the long bond, on the 30-year. Those are pretty typical rates, historically speaking. Those are not particularly high rates. But that recency bias that is built into our brains causes a lot of people to think, no, this is an anomaly. Interest rates aren't supposed to be 4.5% to 5%. They're supposed to be 2 to 3%. When I took a mortgage out 20 years ago, the rate was, 3.5%. That's what it's supposed to be. And that is one really important bias that causes people to get stuck in, a bad decision-making pattern. Another thing that people do, and this is just part of, again, human nature, is we fall in love with our investment thesis. Okay. We fall in love with stocks. We fall in love with a particular scenario that we have decided to follow. And one of the things that I try really, really hard to do when I'm looking at a particular strategy or an investment opportunity is to step back and say, what if I'm wrong? Okay. What if the thesis underlying this strategy or the thesis underlying this investment just isn't true? What happens then? Okay. So this ability to consider the fact that you might be wrong, I think, is really important. And it keeps you from making big mistakes. We're all going to make mistakes. Okay. That's just part of the nature of decision making, part of the nature of investing. In investing, you hope to be right something more than 50% of the time. No one gets it right all the time. But I think one of the ways you avoid really big mistakes is by taking that perspective that says, what if I'm wrong? What if this isn't true?
So you said that we had a bull market in bonds for 40 years, since the early 1980s until pretty much 2020. A little bit of a provocative question, but do you think like legendary investors in bonds such as Bill Gross and company would have been so successful in today's environment where rates tend to move more into a range but with more volatility than during the period they made their career in, where it was a secular bull bond market?
Yeah. Yeah, I mean, I certainly wouldn't want to disparage anybody's investment track record, and Bill Gross obviously has an exemplary track record. But I will say that having the wind at your back is a wonderful thing. Okay, and so I don't remember if it's Warren Buffett, but let's pretend it was Warren Buffett who said that nobody knows who's naked until the tide goes out. Right.
Yeah, I think it's him. Yeah.
Yeah, I think it's probably Warren Buffett, but when you have a strongly directional market, the wind at your back, a really strong trend, it's pretty easy to look like a genius. It's the hard part is when that trend breaks, do you catch it? And if you're lucky, you catch that break a couple of times, and we can talk about some of those times when I got lucky or smart, whatever it might be. But a 40-year bull market is a great thing to have if you are an investment manager or an investor.
Mm-hmm. So yeah, I definitely want to ask about your best and worst calls. But before that, I loved what you said about the bias of falling in love with our own narratives. And I wanted to ask you, what's a collective narrative that we as an industry had that we wanted to be true, but that clearly proved to be wrong? Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
Wow. I think that there's a few things that come to mind, but one immediately is the idea that volatility and risk can be measured just by looking at standard deviation of returns. Okay. So we have this paradigm that goes back a long way. Okay. Fama and Merton and other sorts of brilliant minds who were creating sort of the modern finance paradigm that we're still working under, the so-called mean variance approach, which basically says, if you can compute the expected return and you can compute the standard deviation of returns, either for a single investment or looking, expanding that and looking at the correlations, which are still just a variance type measure, covariance, you pretty much have what you need to know about your risk profile. Mm-hmm. And part of the reason that was so appealing, because it seems to kind of make a lot of sense intuitively. The other reason that it became really, really popular is because that framework can be analyzed and really taken apart using calculus. Okay, these are smooth, convex, differentiable functions. I don't want to get too much into the mathematical weeds, but they're mathematically really tractable. And so people could do a lot of different things with this pretty basic paradigm. And there was this notion that developed and is still very, very widespread that variance, standard deviation, is the best measure of risk in an investment portfolio. And that turns out not to be the case. Okay. First of all, what you really care about is losses, right? And you can have stocks that are, or any kind of investment that's very volatile, but it's mostly to the upside. Now, is that risky? Yeah, by some definition, that's risky, but I think most people would love that kind of risk.
Mm.
So as you're thinking about, as an investment manager, as you're thinking about risk, I'll give Warren Buffett another shout out here. He said there's really two rules to investing and managing risk. The first rule is don't lose money. The second rule is remember the first rule.
Mhm.
Okay. So not having drawdowns, avoiding big losses turns out to be way more important for managing investments on the ground in the real world than really carefully measuring standard deviations and variances and covariances.
So you think max drawdown is the best measure of risk?
I think it's a pretty important one. I think
Mhm.
that the losses, first of all, as a human, again, getting back to human biases, we tend to feel the pain of losses much more than we feel the pleasure of gains. That's a well-known psychological phenomenon. But again, mathematically, recovering from losses is really tough. Okay. If you have, just to use really simple numbers, if you have a 50% drawdown, to get back to even, you need to have a 100% return. Okay. So the math on losses is pretty brutal.
Mhm.
So I think that you still need to compute variances and covariances and those kinds of things in terms of your overall investment approach. But that can't be the end of the way you're thinking. You really need to think about how do you avoid big losses, big drawdowns. And again, that gets back to the point I made earlier. What if I'm wrong? What would be
Mm.
the consequences if my investment thesis isn't right? Could it result in a big drawdown? In that case, maybe I want to take some mitigation to this strategy to avoid that possibility. So thinking about things in those terms, it's not as neat mathematically, but it's really necessary if you're gonna make money.
So I want to talk now about what you were saying before, the good and the bad traits. Can you maybe give us an example of each that you had in your career, and more importantly, what you learned from both of them?
Right. I will start with a good trade that I had, and then we'll move to the many mistakes that I've made over the years. Um, and I've been involved, as we talked about earlier, mortgage-backed securities and asset-backed securities for a long time. That's where I really got started on Wall Street. And in 2005 and into early 2006, I was looking at what was happening in subprime mortgages and alt-A mortgages, and I said, this is going to end really badly. This is 2005 now. And I was working at a hedge fund at the time, and just looking at the origination criteria that people were using to generate these loans and looking at sort of the early trends with people defaulting right out of the gate and things like that. I said, this is not going to go well. And the origination volumes were exploding, right? Wall Street just couldn't make enough of these bonds. They were making them as fast as they possibly could. And so I said, you know what? This is going to end badly enough that I think we need to find a way to short this market. And the credit default swap had just been invented. Okay. It had been sort of in the works for a while. And when the credit default swap came along, I said, this is how we're going to work on how we're going to exploit this idea that the subprime crisis is going to come at some point. And so we launched a fund that had sort of the big short style trade. And, long story short, it did very well. But during the time
It didn't do
between,
well, or it did, you said?
it did very well. Yeah. Yeah. It
Oh,
did
okay.
extremely well. And but during the time that we were trying to launch this fund, and even after the first leg down in 2007 into early 2008, people were like, you're crazy. You're going to lose money. The national housing market has never declined in uniformity the way that it has to for you to be right. There were a lot of people who said you're just a doomer, you're a perma-bear, all these kinds of things, and it turned out to be right. And it turned out to be a really serious, obviously the great financial crisis destroyed a lot of wealth. It destroyed lives. People lost their homes. They lost their jobs. It was a serious downturn in the global economy. It was exacerbated by the CDO phenomenon, which we can talk about if you like. But all of this goes to show that even when you get it right, you're going to have a lot of people who say you're wrong. It doesn't make any sense. You're just being a doom and gloom. And we're seeing some of that right now in terms of inflation and interest rates and tariffs. So we can get into that a little later. But that was clearly a good call, and one that we were able to execute on and make a lot of money for our investors.
You could have been featured in the Big Short. I have the feeling that I was hearing the script of the movie, no?
Yeah, it was. I mean, there were, if you talk to people now who were in the business at that time, we're talking now almost 20 years ago, everybody will say they had that trade on. Oh, we had the short trade on. We knew subprime was going to blow up. Not true. There were a relatively small number of folks who really put the trade on in size. We were nowhere near the biggest. You had Paulson, who had a lot of money raised in this trade. But for our investors, we were very happy with the returns we were able to produce for them.
Yeah, forget Michael Burry. You can get Dean to
Michael
make
Burry,
the
and there were a small number of people who made an awful lot of money, and I have to say that when you were in that trade, it didn't feel good. Okay, it definitely felt. We knew that every time, the subprime index went down another 5-10 points, that meant that people were losing their homes. Okay. But your job as an asset manager is your job. And this sounds very cynical, but it's true. You're not there to save the world. Okay. We're not curing diseases. We're not curing starvation. We are there to make money for our investors and protect them from loss. And that was, at that time, that was the best way to do that, even though it didn't feel good, on a personal level, to be sort of betting against the U.S. economy.
What about a bad trade? Where did you lose a lot of money, and what did you learn from it?
Well, we had at the same time. This is going to seem maybe a little ironic, but at the same time, we had other investors who didn't want to put the short trade on. Okay. They didn't buy that thesis. They didn't agree that the subprime crisis was going to become as bad as it ultimately did. And we allowed those investors to stay in what we believed was a losing trade, because that's what they told us they wanted. And with the benefit of hindsight, I wish I'd have been more forceful with those investors and said, no, this is not going to go well for you. We've got this other strategy here that we think is really, really good. If you want to stay in this trade, this long credit trade, you can, but here's your money back. You have to do it with somebody else. We think this is irresponsible. And I didn't push that hard enough. I kind of wish I had now. But again, if the customer comes on to your car lot and wants to buy a gas guzzler, even if you think that's probably a bad idea, you're probably going to sell them the car. Again, we're in the business of meeting investors' needs and desires, and if people want to do something that we don't think is the smartest trade out there, it's kind of a tough call whether you do the best you can for them within the parameters of what they want to do. I mean, for example, right now, if somebody came to me and said, "Listen, I think all this tariff stuff is overblown. I think that the administration is going to get control of the Fed somehow, and they're going to slash rates, and we're going to go back to zero. Could you put that trade on for me?" Today, I would not do that. I simply wouldn't do it. I would say, you have to take your money somewhere else. I will not let you, I will not allow myself to be part of what I think is just a really dumb idea. So, yeah, there have obviously been other mistakes that I've made. I spent a lot of time thinking that the rating agencies, for example, were onto something in the way that they rate a lot of different sorts of securities. I wasn't skeptical enough about both the flaws in their models as well as the conflicts of interest that they had, which are massive. And particularly, during up in the run up to the financial crisis, the conflicts of interest that the rating agencies had were really pretty severe. And today, I put exactly zero value on a credit rating.
You never read rating reports?
Don't care. No, the rating agencies have shown themselves to be the credit rating is a very low signal. It's all noise. It's just not worth. It's not worth anything. I'll give you an example. There was a story in the Wall Street Journal about Worldwide Plaza in New York City, which is a massive landmark building on the west side up on 8th Avenue. And that building has had a loss in value of around, if I'm remembering the number right, 75% or so from the value that the building was appraised when it was originally securitized into a single asset, single borrower, commercial mortgage-backed deal. So it's lost 3/4 of its value. The senior bonds were originally rated AAA. Those bonds are going to take losses. They're going to take losses of somewhere in the neighborhood of 20 to 40%. We don't know exactly, obviously, but they're going to take severe losses. Those senior bonds are still rated investment grade. They're still rated BBB minus, even though we're staring at losses that are for sure going to come through. So what does that tell you about the ratings process? It tells you that it's completely broken.
Mm. Well, personally, I like to read ratings reports, always to be taken with a pinch of salt, but it's always like a good starting point to start reading about a company. But then I agree, like you need to maybe dig a little bit deeper and and form your own opinions. But
Well, here's the thing. If I won't say that the reports themselves are completely useless. I would say that in many cases, whether you're talking about structured products or whether you're talking about corporates, they do a pretty good job of gathering and synthesizing information. Okay. They pull information from the issuers. They get information about the markets and things like that. So if you were to read the credit rating reports right up to the point where they give you your rating, you're probably okay.
Yeah, at the same time, it's not an easy task, right? Like it's markets are always moving, things are changing, and in some way, it's impossible to predict the future. I think where there's definitely room for improvement is on how reactive they are in updating these ratings. But a lot of things are hard to predict. It reminds me a bit of the job of auditors. Like sometimes they get tricked too, and they're supposed to be the ones, telling us, okay, these numbers are real, these numbers are good, these numbers are trustworthy, and then all of a sudden one day we discover, as we've seen with some very big names in the past few years, that it was all smoke, and and then you start wondering, like, okay, why why am I even listening or reading what these auditors are producing if they can also get it wrong?
Yeah.
But yeah, it's never black or white. I think it's a little bit tricky. But talking about then what's trustworthy data, are trustworthy numbers, I'd like to hear, what is one piece of data that you trust when things get volatile and you're looking at let's say the world and macro specifically. Hey there, quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
Right. Well, the primary source of information is prices. Okay. The price is the price. And, with rare exceptions, maybe private equity, we can, talk about if we want. But if anything trades in a market and the price is observable, that is telling you a whole lot about what you need to know. Okay.
Mhm.
Because the price is the collective judgment of a whole lot of people. Okay. And, there's a phrase called the wisdom of crowds, right? And if you look at and can find some way to synthesize and pull together a whole bunch of diverse opinions and figure out sort of what the consensus is, that's the price. And it's observable and you can see it, in real time. So that is something that, doesn't lie. Prices can be wrong in terms of relationship to fundamental value and so forth. But in terms of the best signal that we have out there, it's price.
So
Go ahead.
sorry, you believe in the efficient market hypothesis then, and you believe assets are priced correctly at all moments in time?
That's not the same thing. That's not quite what I said. Okay. So for example, if we go back to the subprime example, the prices of those securities were before the financial crisis. These were triple B bonds that were trading at, 120 basis points over LIBOR.
Mm-hmm.
Okay. So that price was there and it was observable, but doesn't mean it was right. What I'm saying is that the price is an unimpeachable signal. Okay. It is a true thing. Unlike, for example, we've had a big controversy recently about numbers coming out of the Bureau of Labor Statistics. Okay. They had that big revision down in the jobs number a few weeks ago, really big. I mean, they cut it down to almost nothing. And so that data is very noisy, not just in terms of, what does the labor number tell you about what's happening in the economy, but just, is this number correct?
Mm-hmm.
Okay. And we're finding now with lots of numbers that are coming out of the government that there's a lot of noise in these numbers. And I don't think it's because of political bias. I really don't think that there's a cabal of people inside the Bureau of Labor Statistics saying, how can we tweak these numbers to make things look better or worse than they really are? I think it's that some basic government functions relating to gathering data, analyzing data, disseminating it have been really neglected for a long time, not just for the past couple of years, but for decades. And so, if I had my way, one of the things I would have put in the last budget bill was a line item to really upgrade the data collection and data analysis systems at the Census Bureau, the Bureau of Labor Statistics, Commerce Department generally, because the data coming out of those entities is pretty poor quality. And so people need to look outside of those channels, and sometimes you'll hear it referred to as alternative data.
Mhm.
And people who have a need for high quality data are doing that, and they're buying it on their own. Hedge funds and people who have a strong need for data can do that, but that's very expensive. And for people who are trying to make policy, um, that's not really something that's available to them. If you're talking about people at the local level, you're talking about how do we, how many schools do we need to build? How much
Mhm.
water treatment do we need to build? These people rely on government statistics about a lot of things. And if the quality of that goes down, it cascades far beyond sort of what am I going to trade next week?
Mhm. That's a very interesting point. Um, it makes me think about, clearly you spend so much time looking at the screens, at markets, reflecting on all of these things. I'm wondering, is there something like a question that a person like you, clearly with a very deep overview of finance and all the corners of markets, is there a question that you haven't really figured out yet that keeps haunting you in some way?
Yeah, there is actually one word, Bitcoin.
Mhm. So
I,
what's your take?
I don't own any. I've never bought any cryptocurrency of any kind. I'm not going to say that it's illegitimate or that it's a scam or anything like that. There are plenty of scams in and around the crypto industry, but cryptocurrency as a concept, Bitcoin or Ether, whichever ones, I just can't find the use case. There is a writer who is a columnist at Bloomberg named Matt Levine, who's wonderful. I highly
Oh yeah,
recommend
he's great.
his stuff is great.
Yeah.
And he writes about Bitcoin from time to time, and he kind of amusingly says, the crypto industry keeps rediscovering fundamental practices of finance. So they're sort of it's a solution looking for a problem.
Mm.
And I am fully prepared to be wrong on this. Okay. Like I said before, but one of the things I always like to do is step back and say, what if I'm wrong? Um, when it comes to cryptocurrencies, I haven't found out anything that makes me think I'm off base here. But I don't see it becoming a fundamental part of the financial system, not in, sort of whatever's left of my career.
What's crazy about crypto and Bitcoin specifically is that it's super polarizing. I mean,
Yeah.
either you are like a big fan of it or you are super skeptical. And I was wondering, has there been other instances in your career in markets where you've seen something else, an asset, a story, an asset class that polarized crowds as much as crypto is doing nowadays? And how did that end up?
Yeah. Well, there are a lot of people who, when we were raising money for not for the short fund, but for just the traditional structured products fund, there are a lot of people who say, you guys blow up, every 10 years. And it's like the proverbial picking up, nickels in front of a steamroller,
Mm.
to a lot of people. Just the frequency and the magnitude of the corrections in that market tend to scare a lot of people away. I don't agree. I think that securitization has been, on balance, highly beneficial. I think that it has broadened the market for lots of consumer finance products. It's made mortgages. I mean, without Fannie Mae and Freddie Mac, those are securitizations, right? Fannie Mae and Freddie Mac. In addition to all of the private label stuff, it has made mortgages much more affordable than they would have been had you, if we went back to the system of, you got a loan from a bank and they held it on their balance sheet forever. Okay. The securitization phenomenon has greatly improved that consumer finance product. Same thing with credit card securitizations, auto loan securitizations, and so forth. So, there are people who say, structured finance just doesn't make sense. It's a scam. Again, it blows up. But I think that as an investment manager, I believe that the risk there is manageable, getting back to that downside, getting that the risk of big drawdowns is manageable. And on a risk adjusted return basis, it's been pretty good for a lot of investors.
Well, thank you for that. We're getting close to the end of the conversation.
Oh boy, it's gone fast.
Yeah, I know. We've been talking almost for an hour. I wanted to dig deep a little bit more into securitization and things like that, but maybe we can leave that for a future episode. I'd like to maybe turn to the future, given that we just have a couple of minutes left, and I'd like to ask you. You've been in the industry for decades. What is a piece of advice that you'd give to anyone starting in finance today?
Well, I was for several years here in Charleston. I was an adjunct professor teaching finance at the College of Charleston, which is a beautiful campus and a wonderful school. And I always told my students, and I would say this to anybody who's thinking about a career in finance: study as much math as you possibly can. Study math until your brain is about to explode. Because when you get out into the real world, you get that first job on Wall Street or wherever it might be, at a bank, insurance company, you can learn the finance side of things. Okay. They can teach you about asset liability management. They can teach you about portfolio construction, all those kinds of things. What they can't teach you is math. Okay. So if you don't have that fundamental grounding, it's going to be really tough to go very far in finance. In addition, I think today it's really imperative for people getting into the industry to have some familiarity with machine learning and artificial intelligence. Okay. You don't need to necessarily be on the cutting edge of building large language models and the kinds of things that people are getting $100 million, signing bonuses these days to do. You don't need to be quite that deeply into it, but you need to have some real familiarity with it, how it works, not just playing around with ChatGPT. Drill down, think about and learn about how machine learning algorithms work. Learn how neural nets work. Okay. Figure out at least, the fundamentals of how these systems and models work. And I think that will become not just a nice to have, but an essential skill going forward.
Do you think AI will do the job of a chief strategist or a fixed income advisor 5-10 years down the road?
But 10 years is a really long time. I would say not in 5 years. I think that there are a great many innovations that are coming out of the AI industry right now. I think that a lot of those have to do with the agentic trends. I'm not sure if your audience is familiar with agents, but it's going far beyond ChatGPT. Sort of ask it a question, it gives you an answer. These agentic models actually have the ability to interact with the real world. Okay, with your accounting systems, with your customer support systems, with production and all sorts of transportation logistics. They have the ability to really engage with your business processes. It's just getting started. But in terms of, is an AI going to replace what I do in 5 years? Maybe this is hubris on my part. I don't think so. but I use AI all the time and it's a great help. So there's an expression that says, I think this is a good one. It says, AI isn't going to replace you. Another human using AI is going to replace you. And I think that's true.
Yeah, I agree with that. And I'm also very keen on the whole thing. I'm an optimist by nature, so I'm trying to educate myself, learn how to use the tools, and become part of the change rather than just being oblivious to it. But for sure, I think this is going to change things like nothing we've ever seen before, and everyone should be paying attention. By the way, this is a recurring topic in all of my podcast episodes. At some point, everyone talks about AI, and I think there's pretty much a consensus. Everyone is aware of the importance, and everyone is saying this, and you got to get into it and familiarize yourself. Where I see a little bit of divergence is the degree to which you need to get into the technical side of things, like coding and learning those neural networks and how they work and so on, or just getting familiarized with the tools that have a nice UI and allow you to do already like pretty sophisticated things, but without knowing or having to write a single line of code. So
I think that your question, and I hope I didn't, sort of overstate the case. Your question was about somebody wanting to get into finance. And in that case, I think you need to have a little deeper dive into it. If you're going into sales, probably not. You need to have sort of a familiarity with the models and, how to interact with them on your computer and on your phone and so forth. That's a different skill set and a different expectation in terms of technical expertise. If you want to survive and thrive in real finance, managing assets, trading, structuring deals, I think you need to dive a little deeper.
Well, Dean, it's been absolutely amazing having you on board. I haven't seen the time pass, 1 hour talking already, but it's been absolutely wonderful. For those of you that would like to stay in touch with Dean and follow up how things are going with FolioBeyond and so on, please make sure you follow him on LinkedIn. He's a very prolific, I would say, creator across the board. You'll see plenty of interviews with big media outlets, YouTube channels, and so on and so forth. So he's very easy to keep an eye on and see how he develops. And best of luck with what you guys are currently building at FolioBeyond. I'm excited for what's ahead for you. And once again, thank you for coming to The Blunt Dollar.
It's my pleasure. I really enjoyed it.
The Blunt Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blunt Dollar for more raw, honest finance conversations.